Hi, good afternoon, everyone. Thank you so much for joining the Corporate Insight by ProsperCap Corporation Limited. I'm Serena. I will be the moderator for today. So a little bit of introduction about the company. It is actually a real estate investment and management company that focuses on building a diversified real estate portfolio across a various geography, with the emphasis of the ownership and management of global hospitality and lodging assets. It currently owns a portfolio in 17 upscale hotels located across the United Kingdom. The property are managed by one of the leading hotel operators, experienced with the international and multi-brand hotel portfolio, and operate under the franchise agreement with a well-known international hotel brands, including Hilton's, IHG, and Marriott. So today we are very happy to have a ProsperCap, a CEO and Executive Director, Mr. Iqbal Jumaboy, and the CFO, Mr. Oi Chi Eng, for us to know more about ProsperCap. So Mr. Iqbal, the floor is yours. Thank you very much.
Thank you so much, Serena, and thank you everyone for joining us today. It's a pleasure to be here. I love talking about our business, and therefore I'm grateful for this opportunity, and I thank Securities. Serena, would you be comfortable if I actually got into the presentation proper at this point?
Yep, sure.
Yeah, and I think Chieng is still trying to log in. He's in the other next door room, but we'll try and keep this going. In order so that I don't put everyone to sleep, Serena, how long do I have? The whole presentation.
The whole session is 1 hour, but
Yeah.
we maybe leave some half an hour for Q&A, perhaps.
Perfect.
Yeah.
Perfect.
Thanks
So
very much.
just a little bit about us. Let's go. I think that I won't read the disclaimer, but I hope that you have all seen it. It is exactly basically saying that we were formed, as Serena said, through a reverse takeover of a catalyst company, and Prime Partners Corporate Finance is the financial advisor to the RTO. Let me keep going, and then we'll see how we go along. What we're looking at as an agenda for our presentation today is to give you an overview of the company, about our business, our portfolio, some of the key events, because people may not be familiar with with all the activities that are going on. We'll talk a bit about the financial highlights and then where we are going. Before I go into the actual property itself, I just into the company. With each picture, I'll give you a little bit of an overview. This is our hotel in Glasgow. The relevance is not a hotel as such, except to explain some of the dynamics. It's a Crown Plaza under franchise from IHG, and it's managed by us and through our partners Valor. What's most important is the buildings you see behind. One thing they call the Armadillo, and behind that Hydro. These are basically exhibition centers, and it's like being in Changi Expo as well as Marina Bay Sands at the same time. So you have the expo, you have events taking place, you have concerts taking place, most of which, by the way, I don't really understand. But anyway, the music, but let's go on. We are, as said, we did a reverse takeover. Our current shareholding is where our parent company, DTP Interholdings Corporation, or the DTGO Group, owns 84.85% of our shares, and we have a free float of 15.03%. I see Chieng has joined us, so we've solved our technical issue. As you know, we're listed on the Catalyst board. Our share price, which actually, I mean, I will not go into valuations, but Chieng will cover the book value of our shares. But it's certainly trading below that at the moment. But over the 52 weeks, it has actually ranged from the current price, which is at an all-time low, to close to 20 cents a share. We are, as Serena said, a real estate investment and management company. We're headquartered in Singapore. Our goal in the future is to build out a portfolio of assets across different geographies. We are focusing on hospitality and lodging for the moment, but our charter allows us to go beyond that. We currently own 17 hotels. They're predominantly upscale. They're over 3,300 rooms, and it's in key regional cities in the UK. Now, every time when I say we're in the UK, they say, "Oh, you're in London." And I try and explain something, which is that the UK and London are two different countries from a hospitality management perspective. London is an international city with a different set of dynamics. The regional cities have a different dynamic. Primary difference is that international events have less of an impact in the regional cities than it does in London, and our business is focused more on UK related business versus purely visitors coming in and out of the UK or through the UK. Our goal ultimately is a long-term value-added strategy. So we need to be innovative. We align with our ESG principles, and as we build ourselves, we intend to be a leader in the creative investment alternative space. So this is I don't know actually whether we're the only player. I know there are other players in the hotel space, but we think we're probably the only listed player that is currently in the UK, in purely the UK space. Of course, there are other big players like CDL and others who have UK portfolios in Fraser. What's our vision? Now, I generally don't try and read presentations. I prefer to talk about them, but in this particular case, I'll read some aspects of our vision, which I've already stated, which is to be an industry-leading manager of real estate assets. And we want to be recognized as such, which hopefully will be recognized by all of you and will reflect in our share price ultimately. We will create investment products in both public and private markets, serving a diverse group of stakeholders. Stakeholders, very careful, because it's not only shareholders, it's all of you as well. You're our stakeholders. But we want to earn your respect for integrity and consistency. We need to be innovative. We need to execute our business strategies flawlessly. And therefore, for our customers, we would need to be the preferred choice, and we need to optimize returns, without which our shareholders will not be supporting us. And our people are of major importance to us. When I tell people we are a startup, they say, "How many people do you have?" And I say about 2,000. So we're not really a startup in that regard. We have established businesses, but our Singapore and Bangkok and UK offices are not that big. But we want to be respected by our own staff, who will then work to create value for you. I won't read the whole mission. You can do that. But something that's really important to us is, number one, our core values. Financial management is very important to us, sound financial management, which we are slowly building as we move forward. Industry leadership, so people recognize us. Already, I think we have achieved some of that, and people are beginning to recognize us, particularly out of the UK. And the other part is in order to make sure that we deliver in a superior manner. We have it's a diversified but quite interesting board, with people with strong backgrounds, whether it's in banking, such as our chairman Kuntiranan, or in investments, our vice chairman. My own background, I think most of you know, I won't go into it. And others who have hospitality, others who have properties, such as Chris Tang, our independent director, and others who have a strong finance background, such as Chu Chun Wee, who is an ex Big Four auditor, as well as continues to be working in that field. What is if we talked to us a year ago, or when we listed, we had hardly anybody. When I joined as an advisor, we had two people, myself, one person, and then we hired a HR manager, and that was it. Today, apart from myself, Chieng, who will be speaking with you in a short while, is our CFO, comes with a background in various public and private markets. We have uh, John Fung, while he is actually based in Manchester, is our VP for asset management in the UK. He is an interesting guy because he's originally from Hong Kong, but has been living in the UK for several years. He has worked his way up from waiting on tables all the way up to the top in the hotel space. So very happy to have him on board. Ben Tan is our legal services head. Ben has worked in apart from law firms, he's worked in public companies for a long time. So again, very experienced. Zin has worked in REITs. She's worked in hospitality. She's worked in real estate and is our group financial controller. And Apa looks after corporate finance. She has an MIT degree in finance. She is has worked very closely with me on the refinancing of our portfolio last year and is working on various transactions in the corporate finance area. We've built a larger team around that, but I won't spend more time. Uh, as I promised you, I would just briefly talk about the pictures as you see them. This is actually the conference center portion of our Nottingham hotel. Chiang and I visited this hotel recently. It's a highly successful conference venue and is a market leader in the Nottingham in Nottingham. So we have 17 hotels, as Serena said. We operate with the operating structure. Well, actually, let me say something. First of all, they're premium hotels. They're in key regional cities. And we'll come back to the implications of being in a regional city versus elsewhere. We we basically own most of them, or approximately half of them are freehold. The other half are long leasehold, so effective freeholds. So it's a very stable portfolio from our perspective. We have three franchisors. We operate using brand names, brand standards, and most importantly, for all of you, the booking systems and therefore the customer base of IHG, Hilton, and Marriott. So all major brands, all very well established, all with very strong positions in the UK, which we lever off. The way we operate, we have ourselves, we have the hotels, and we have a management company called Valor, which is handling our day-to-day management. We use the brand standards using a franchise model from the three major brands. So Valor does the operations management, including helping us with the HR of the hotel team, not of our central team, the revenue management, and making sure that the hotels adhere to brand standards. In addition to that, they have strong people that we can back into for any kind of physical redevelopment of sites. And we'll talk about some of those in a bit. And they also have a strong team working with us at the moment in the F&B area. This is a great slide with lots of words and lots of numbers. I'm not going to read any of it. You'll be happy to hear. But what I wanted to say, I think the only takeaway you should see over here, the key takeaways, is that there are no hotels with less than 50 years, none. The shortest leasehold we have is in Stratford, and that's 74 years. So so they're all very long leases. The hotels were constructed at different times. That presents and that means it's very stable, but it also presents an opportunity to us over the years to then upgrade and bring them up to the latest standards. I've talked about the keys, and the gross floor area is almost 2.4 million square feet. These are more pictures of the hotels. I won't go into any detail, but it, it gives you some perspective. They're very different in style. They have different marketplaces, and therefore the selection of brand names, the selection of franchisor is to a large extent driven by what the market would want in those locations. Um, this hotel, which is also in Chiang in my background, is our Manchester property. Um, it's it's a great property because it's across the street from one of the most busy train stations in the whole of the UK. So it's a question of being ready and open, and and uh, and we fight for the business with a few other properties, but it does very well. What did we do? Let's go into a few things. First of all, I think all of you are aware of our in 2024. First of all, was we've been operating about a year and a half as a company. Um, we listed the RTO list commenced on the completed on the 23rd of January last year, and we commenced trading on the 26th of January. It was pretty much I think it's quite a different company. Um, the core points I want to make is that it is stable, it's income generating, and having this portfolio gives us a good base to build out the company. In April 24, however, there was a fire. The slide says accidental fire. It was an arson attempt by somebody who's had a mental problem. But anyway, the core point is that we were fully covered by insurance, not merely for the damage, but also for business interruption. And we have booked uh, a lot of that revenue. Obviously, for damage, it goes out in terms of resetting up the hotel. And the only thing I'll tell you is that it is working full at the moment. And that asset protection strategy we've carried through for all of our hotels. Um, I'm grateful that we haven't had to implement it or actually make use of it anywhere else, but it proved that our strategies in that regard were correct. One of the key things that we did was to work with Hilton that wanted us to improve and invest in our properties. We have 6 Hilton properties. We completed 2 of them, basically Manchester and Leeds, by August last year. It basically was one of the first parts where we want to enhance our assets. Why do we need to enhance the assets? We need to enhance it to keep the assets current. We need to enhance the assets to keep the market interested in what we are doing and to keep our revenues either where they are or better. One major thing for us, I'm not sure if any of you followed us at that point, but we were funded using a bond. We had raised a corporate bond before that. We inherited that product. We felt that as a company, we needed better relationships with our bankers. So we refinanced our entire portfolio. We were very happy that 2 major international banks, Deutsche Bank and Standard Chartered Bank, led that facility, and we raised 310 million pounds in September last year. It was, as I said, it was very important that we could get that institutional credibility, but also we intend to lever off that for the future. The Crown Plaza Stratford, I mentioned, we talked about the fire before. Well, that fully reopened. What actually happened? The fire actually did not affect any of the rooms. It affected, in terms of the actual fire, it actually affected the kitchen, and one of the ballrooms was slightly affected. The rooms, however, had a lot of smoke problems, which meant that we had to redo soft furnishings like carpets, curtains, etc. So across the hotel, but the kitchen and the ballroom are now brand new and taking people in. So in a sense, we don't like fires, but at least we have very good facilities at this point. And that revenue stream, while the profitability was not affected because of the business interruption insurance, but having the revenue stream, having people going through the doors has been very useful, particularly at this time through the summer. We talked about the Hilton PIP, the Property Improvement Plan. We went through the second phase, and we commenced the four remaining Hilton hotels. They are actually in late stages of completion, and by the end of August, we should be fully done. Ching and I actually visited all of these, and I think we're pretty happy with the renovations that are going on. This hotel was one of those that was redone. This is the DoubleTree in Leeds. It's been completely redone with so the rooms are looking great, with a sky bar on the top, which is, if I'm not wrong, the only one in Leeds. So that's where we are. But this is where I too will just step away for a few minutes and request my colleague to take over, and I'll come back a bit later. Chiang, can I introduce you and request you to share the rest of the insights? Just let me know, since I'm driving here, just let me know when you want me to click the slides. Yeah.
Yeah. Hi, thank you, Iqbal. Good afternoon, everyone. Happy to have you here with us, and thank you for joining us today during this lunch hour. I'm pleased to share with you a brief overview of our financial year 2024 performance. Iqbal, can we move on to the next slide? Yeah. Here we have more pie charts and vertical bars so that the financial numbers are not so boring. Right. From here, I'll begin with a look at our revenue by geographical and business vertical, move on to the key operational metrics, and then walk through our financial performance from the income statement through to the balance sheet. Now, let's look at the top left-hand corner, the revenue by geography. In financial year 2024, our revenue remains heavily weighted towards England compared to Scotland, which contributed about 85% or 84.9% of the total revenue. This concentration shows that the strength of our operations in England and our continued stability of our asset base there. Moving on to the top right-hand corner, we have the revenue by type or our business vertical. Accommodation continued to be our primary contributor, accounting for 67% of our total revenue 2024 as well as 2023. The F&B segment contributed 27%. These two segments contribute the majority of our total revenue, while the balance revenue comes from our meetings and parking department. The consistency of this distribution indicates the resilience of our core offerings. Moving on to the bottom right, you will see the vertical bar charts comparing the prior and the year of 2024 against 2023. All the key operating metrics have shown improvements. On the left-hand side, we have the occupancy rate, which have increased to 79.7% for our portfolio of 17 hotels. For the average daily room rate, or the ADR, we have improved to $101 from 99.4%. For the RevPAR, which is the multiplication of the occupancy rate and the ADR, we have also done well too at $80.
Yep.
Okay, moving on to the top bottom left corner is our financial performance. For revenue for 2024 came in at 246 million, which is slightly above the 242 in the prior year. Gross profit also held steady at 133.8. We reported a loss before tax of 37.3 million, compared to a profit of 46.5 million. This was largely driven by a few non-recurring items, including the deemed listing expenses, which I think Iqbal had mentioned earlier. We have a RTO January last year. It cost about 10 million. The insurance claim of pertaining to our insurance from the fire at Stratford. When adjusted for these exceptional items, our normalized loss before tax narrows to 14.7 million, showing improvement from a normalized loss of 23.9 million in 2023. These numbers are also available in our HGX announcement of condensed interim financial statement. The normalization help reflects the underlying performance of a business more accurately. Moving on to the balance sheet metrics, the net asset value had dropped to 14 cents per share, reflecting a loss recorded for the year 2024. And also similarly, earnings per share also show a loss of 2.68 cents. On a more positive note, we also pared down our debt, and therefore our gearing had improved from 2.54 to 2.13. Moving on to the next slide. I think, yeah. The next slide shows the real growth of our revenue. Remember earlier when Iqbal mentioned that we have a fire at CP Stratford? This happened in 2024. When we adjust for a like-for-like basis in 2023, our actual revenue grew by more than 5%, actually 5.1% against 2023. So it actually denotes that our portfolio of hotels have a stronger revenue growth on an adjusted basis. Moving on to the next slide, our gross profits have reflected a decline of 0.2%, mainly due to the higher payroll costs arising from a statutory wage increase in UK of about 9.8% from 1st of April 2024. But also, if we do a similar adjustment for CP Stratford, in actual fact, our gross margin growth is a more robust 4% compared to a drop of 0.2%. Also, I want to highlight that we have our portfolio of hotels have performed better than the competitive set of hotels, which have registered a decline of 3% for occupancy rate and 1.5% for the RevPAR for 2024. So overall, I think our portfolio of hotels had done better than the comp set, and we have proven our resilience. And with that, I pass the presentation back to Mr. Iqbal.
Thank you so much, Chiang, for that. This particular picture, by the way, is I don't know which of you, if any of you support football, but this is our hotel in Liverpool. This beautiful outdoor area. It's a small hotel, and it's where we actually are doing some intensive work at this hotel. It's very cool in terms of the way it looks and feels, and Liverpool is a great city. Just to give you a little bit of background in terms of the operating environment, the core point is the GDP growth in the UK. It's currently growing at a smallish level of 0.7%. So if you look at our last year results, actually we beat the GDP growth. The unemployment rate remains very low. It's 4.6%. The inflation rate has gone up a little bit. The interest rates have remained reasonably stable. They came down a little bit last year, but remain stable. We're hoping that let's see what happens as we go forward. The hospitality market is expected to continue its growth at 2.5%, 2.54% actually. The major players in the market are Travelodge, IHG, Accor, Whitbread, Marriott, and Hilton. So if you look at these 6 names, we work with three of them very closely. To be frank, Travelodge and Whitbread are not, which is Premier Inns, are not really directly competitive nor directly in our space. So if you take them out, there are four of them left, and three of them work with us in a very close basis. We expect the UK to based on external statistics, this is really coming from KPMG, expected to rebound significantly in 2025. Obviously, we worry about a few things, but before I go to the worries, hospitality, we actually are seeing a steady growth. The global travel market, despite all the noise, continues to be resilient. And if we get a better interest rate environment and therefore a weaker pound, the UK will become more attractive. There are, of course, uncertainties. Let's not try and gloss over the fact that there are uncertainties. Whether it's political tensions and trade, but then the trade wars actually have caused much more uncertainty than anything else. And therefore, it's strained operational costs, particularly in the UK. The new government has increased employers' national insurance contributions, the national minimum wage. These are things that we have to deal with in any environment, and we're not alone in having to deal with it in the UK, which we are doing. I can talk a bit more about that if it's interesting, but let me keep going. Let's talk about where we are going as a company. What are we doing? First of all, we see a wheel that we work with. One, our investment strategy. Where are we going? It's initially hospitality. We are obviously, our charter does allow us to do non-hospitality real estate classes, but for the moment, it's hospitality or lodging related. And the idea is to drive that portfolio value through obviously operational improvements, but also to make sure that we keep our emphasis on ESG. One of the things we're doing in that regard, so that, these are nice words. Everybody uses words like ESG, and nobody knows what it means. Nobody knows what they're doing. But what we're doing is we are working with our partners at Valor to convert our power plants. All of our hotels use a lot of power with regard to heat in the winter and air conditioning in the summer. And the question is, how can we shift to cleaner fuels, coal to gas, and where we can to use renewables such as solar. So we're working on that. Many of our hotels have been converted. We are now looking at the next one where we are renegotiating agreements to make sure that we have better, cleaner, and you'll be happy to hear cheaper, so you can see the dollar sign over there, alternatives for us. The second part of that is then capital deployment. Apart from, we've done our refinancing. Now we need to basically look to acquire assets with good operating agreements, or if they don't have good operating agreements, then we have strategies in place to bring those in, whether it's with franchisors or with management. The core thing is always to be asset efficient and to use best-in-class operational partners, such as whether it's the franchisors like Hilton, Marriott, and IHG, or our partners at Valor. There is no point for us to just sit there and say, okay, we're going to buy right and sell right. We also have to manage right. So value creation and active management is a key part of our strategy. I think many investors sit back, but fortunately we have a bench strength of people who have worked in the field. So we're constantly looking to see how we can optimize our portfolio to create better value, better revenue, better efficiency, better cost management, and to use the industry expertise that we've gained. And the last part is once we have all of that in place, to see how we can best use our capital, whether it's to reposition our properties or to reposition our assets, meaning change our assets, asset light, deploy capital towards other towards other assets that will earn us better. So what are we doing? Number one, upscale our portfolio and enhance our revenue through asset enhancements. The PIP is one of them. The second part is look at our existing income streams. We have just gone through for Chiang, you can correct me if I'm wrong. We went through it's 5 hotels where we went through detailed F&B strategies to say how are we going to better use. From our perspective, a property is just a box. A hotel is a box. There's the service element, etc. You fill it with rooms, and you fill the rooms, you provide the services there. The other parts are your common areas. How do you intensify the use of that? Because it's costing you anyway. And then how do you maximize the value you get out of your F&B? So we are working those strategies in the first instance to see how to drive better, to improve our income there. Cost optimization. We're facing issues with regard to higher people costs in the UK. So how can we do jobs better? Whether sharing services, whether improving our use of technology, all of those are in progress, and we have a program running right this minute. And the next part is to see how can we work with capital providers to fund property improvements and to extend our value creation initiatives. Why should you look at us? Why should you invest with us? Number one, you have lots of choices, guys. So why should you look at us? Number one, we have an established platform. It's established and it's stable. We back into major brands and we are sustainable. Our value creation model is already known. I don't think you need to go very far you don't have to accept my words. We completed the Hilton PIP. We're finishing all of that. We have already seen improvements in room yield, asset valuation. What we mean by that, it's so that you don't think that I'm talking about non-publicly available financial information. I'm talking about our competitive position with regard to other players in the market. And if there's any interest, I can describe that later in detail. And the last is to see how we can, now that we are listed, to continue to use the capital markets in order to support our business. We have a good operator backing, path to sustainable growth, and we're quick whenever we have a problem. We're resilient, we're fast. We're looking at raising third-party capital at the moment. Therefore, from my perspective, but I leave you to make up your own mind, we are, in my view, and in our view here at the company, a unique platform for you for income generating, professionally managed, growth-oriented exposure to hospitality real estate. So with that, I will we'll pause here with this picture of one of our restaurant areas. Serena, should I hand it back to you and stop the share, or do you want me to keep the share? But why don't I open this up?
Yeah, you can. Yeah, no worries. I'll take over from here. Thank you so much for the presentation. Let's move on to the Q&A session. So I do see a couple of questions. So the first one would be, the ProsperCaps actually focus on regional UK hotels rather than the central London. So what actually are the factors that drives the site selection?
Sure. I think I'm going to answer that, if you don't mind, with 2 answers. The first answer is that actually this was the portfolio that we through the RTO acquired. So there wasn't. So I know that's a lousy answer, but that is what the portfolio is. But I think the second part of the answer, if you don't mind me saying so, is that what's the significant difference between acquiring in London versus acquiring regional? The first and most relevant, probably from the perspective of investors, is yield. if you look at regional yields, I'm talking generally here, so I want to emphasize that I'm not talking about any specific non-disclosed market information on ourselves. But if you look at the regional properties, you're looking at a minimum of 6.5% yield. And in some cases, we've seen properties and acquisition prospects at 8% yield. On the other hand, if you're looking at London, you're looking at yields at 5% or below by and large. So what's happening is that, what does that really mean? Now, London yields are good because they're consistent. It's profitable, even though the property value is high, but that requires a much higher equity component if you're going to make your returns. So from my perspective, so those are the core differences.
Okay, thanks very much. So the next question, I think is a topic is quite popular recently. How does the current global trade war actually affect your UK hotel business?
Chiang, I'll take this question, but if you have anything to add, please add as we go along. Yeah. You know what? This trade war news is getting to be a little bit old. Every day there's something new on the trade war. And so we find it, we frankly don't know where it's going to end up. But what I would like to say, it is an important issue because ultimately it raises costs at one side, and it also could change the balance of demand. So those things are relevant. But up to now, we're not really seeing a major impact purely on the basis of the trade war. I would suggest that the core economy is a driver, and I've talked about that earlier. That's where have we actually seen it? Where have we actually seen the impacts? Whether it's the trade war, whether it's international political and conflicts, I can't tell you which it is. But the biggest difference is we've seen a compression in booking times. So it doesn't mean that the numbers necessarily change, but the booking time. So I give you a small example. We have normally when you do a major conference, a company does a conference, they'll book 6 months, a year in advance for your spaces. We recently had Boots, which is a major chemist, right? A chain of retail pharmacies, etc. And they booked a conference with us for a couple of hundred people in one of our hotels, and they gave us 2 months' notice. So people are basically taking longer to take these decisions. That makes planning a little more difficult. It hasn't at this point. It has affected to some extent some demand, but the real impact, that's the real impact on planning. We don't have London hotels, so we're not seeing this drop in tourism or anything like that, because our hotels rely a lot more on local business, local leisure, and there is some element, depending which location it is, on foreign tourism, whether it's in Stratford, where, birthplace of Shakespeare, there's a theater, people come there, the foreign tourists come there. In Glasgow, it's how many concerts and exhibitions you have. Because both our hotels are in Glasgow are walking. One is actually connected to the exhibition center by a walkway, and the other is across the road. So that's the real driver.
Okay, thanks very much. So would you consider of these factors will be the main driver for RevPAR growth in financial year 25?
Ching, do you want to try and pick up that one?
This would definitely have some impact, but in our budgeting season for the next year, we will consider all factors. There are ups, there are downs, and we will come up with a balanced approach. Definitely, the issue of a tariff we will factor in, but it is not as large an extent as everyone believes to be in terms of revenue impact. Cost side, we will be managing our costs with a tariff increases. Because we also, like what Iqbal mentioned just now, we also have our cost optimization strategy to manage any economic impact arising from the tariff increase. So we have a various cost optimization plan in place that we have roll out. Yeah.
Okay, thank you very much. So next question. I think Mr. Iqbal talked about the yield in London and the regional London property market a little bit. I think there's a questions about, is there a longer term ambition to expand beyond the UK into maybe Europe and or maybe Asia? Or currently maybe we just focus on the UK market?
I think, by the way, I think this is an excellent question. It's an excellent question because it really is gets to the heart of where we are going. I think the first thing is this. I think the UK, from my personal perspective, I'm going to tell you that what we do is subject to financing, it's subject to board approval, it's subject sometimes to shareholder approval. But from my perspective, it makes sense for us to be in the UK and perhaps in the developed markets of Europe in the short term. Because why is that? Number one, we have the ability of a platform that we can lever off with regard to management. It means that we can also measure the risk better in markets that are a bit more developed, whether it's currency risk, interest rate risk. So it's interest rate risk, currency risk, operating risk. And as I said, our management partners, Valor, are well represented there. So those are likely to be the stronger initial short-term markets that we look at. When we go further, of course, our mandate is global. I believe that we have had conversations with our major shareholder about expanding to Asia as well in the hospitality and lodging space. We can lever off the strength that they bring. However, we are concerned about, again, about risk, and therefore the initial moves are likely to be in the more developed markets in Asia. Thailand is a little bit different for us because of our shareholder. It gives us a lot of risk mitigation strategies because they have people, they have deep market knowledge. So that is something we may look at. I cannot give you any certainties at this point, because we have not put forward or cleared anything with the board as yet. And as soon as we have concrete plans, we'll certainly make sure you're the first to know.
Thank you very much. I think beyond the geographic expansion, people are more also interested about the sectors. So there's actually a question, will ProsperCap looking to branch out into other sectors apart from hospitality in the future? If yes, could you share more about the roadmap and perhaps a little bit of target regions?
Okay, I can answer part of that question, but not all of it. I think it's a question of time scale. If you're talking about the immediate time scale, it's very unlikely that we'll step out of the sectors that we have direct expertise. We will need to, so if you told me go into, I'm almost afraid to give you an example because some people take that as serious. But in hospital, I think it would make a bit more sense for us to go into other lodging spaces. Let me give you possibilities. Number one, things like extended stay, serviced apartments, etc. Number two, student housing. Now, the only problem with that sector at the moment is that there has been a huge yield compression already there. So being able to buy right and manage right is a question mark. But those are areas that we would consider going down. And there are other lodging related sectors which are likely to be the earlier lower hanging fruit for us versus going into something else like commercial or whatever. The dynamics are different. And from my perspective, we still have a lot of opportunity where we are.
Okay, thanks very much. Let me have a look. I think there's a questions about the financial status. So I'll just combine it. So basically the question is about how do you balance the short-term financial performance with the long-term strategy investment? And perhaps maybe talk a little bit about what is the path to the profitability?
Jane, shall we share that question? Maybe you start off with the first part and I'll pick it up after that.
Our short-term financial performance is guided very much by our budget and forecast. We will be looking towards the achievement of our budget and forecast. And towards the long term, that is I think as Iqbal had mentioned just now, there are many possibilities out there, and we will be very focused on doing our organic growth in terms of expanding our revenue, performing our cost optimization, and looking at our capex maintenance and all this, so that we can deliver our short-term target. So that's where our focus is now at the moment. Yeah.
So Jing, I'll pick up the second part of that question if you don't mind. As Jing has said, the focus, to summarize, the points are: number one, to make sure that we achieve our targets in terms of our budgets, etc. The second is to make sure that we optimize the cost to the extent that we feel is appropriate. Because cost optimization is not just cost cutting. It's to make sure that we deliver and produce the revenue with the costs we have. So that's the second part. The third is to look at our capex and our investment plans to make sure that we can maintain our revenues and provide the services we need and possibly improve our bottom line. So that's, if you like, the short term. You have already seen, and you would have noticed in our annual report, we talked about the CRPS, convertible redeemable preference shares. So from a financial strategy perspective, we're looking at strengthening that balance sheet in order to basically again optimize the use of our properties. So that's if you like where we're going in the short term. We also believe that ultimately we need to strengthen our balance sheet. So we will look at other means in order to build out that balance sheet. I'm not at liberty to tell you at this moment until there's something concrete on the table with regard to what some of those strategies can be. All I can tell you is that these are certainly issues that are actively discussed that will increase, will, if you like, reduce leverage and increase our revenue profile.
Okay, thank you so much for sharing. Okay, since you guys mentioned about balance sheet, there's a question. Can you share more about what are the key consideration that the ProsperCap look at when deciding which property to invest in? Personally, for me, currently, is there any acquisition or maybe like divestment planning going on? Yeah.
Well, at the moment, we have not shared any plans with regard to divestments or direct investments. But I can tell you that we look as a rule, we do have a process, and that's, I think, more important to talk about than any specific deals. One is the closeness to our current portfolio and our ability to manage. Two, risk mitigation strategies. Three, ability for us to look at branding, whether it's franchising, etc. So one was management, but the other is making sure we get the branding. What do you get from the brand? You actually get through brand recognition, you get standards, but you also get access to the database of customers. So that's why, while it costs us money to pay them fees, but you pay fees on what they give you, on business that you earn. So those are, if you like, some of the criteria. So if somebody said, would you buy a 20-room boutique hotel somewhere that's unbranded? The answer is unlikely, because I can't satisfy these criteria. As regards divestments, well, at this point we have not talked about any of those. But as we go forward, we will need to assess how mature our properties are, and number one. Number two, we would look to see what is the forward-looking income profile, and if that is sustainable, should we harvest that and put it into assets where we can have better growth, or should we hold it to provide a ballast in the short term while we look at stuff that needs that can actually improve. So it's always a balance that we have to look at. I think most of you know I've been around this business for a while, and I find that the immediate opportunities that seem to be good don't necessarily pan out in the long term as a company.
Yeah. Yes. Okay. Let's see. There's a question about opportunity. The question is there any room to turn the regional hotels into residential projects? Has such redevelopment actually occurred?
I think very simply, we have not looked at residential projects at this point. We are optimizing our own hotel performance and portfolio, so we have not looked at any of that right now. Also, please remember that I think I'll say the obvious. You guys all know this, but when you change use, there's also a fairly complex process with regard to planning.
Thanks. I think there is a questions mentioned about ESG. Can you share any data or examples that where the ESG investment actually has driven a measurable uplift in return and valuation?
Sure. Ching, I don't think we have any direct statistics, but I can tell you that today, right this minute, we have one project where we are potentially. I say this because there's several parts to the deal. Potentially completely changing our power generation in that particular property. If that happens, we will go off more dirty fuels related. It's one where we've been forced under a contract to buy power from one of the local councils, and we're negotiating with them to see if we can come out of that contract. If we come out of that contract, there will be a tangible lift to our bottom line. With returns, financial returns. I hate the word payback because I usually use present values, but in fact we'll pay for our investment in less than 2 years. So tangible, straight to the bottom line impact.
Right, thank you very much. Since it's already 1 o'clock, I would just maybe take one last questions about the financials performance. So there's a questions about, is there a dividend plan or any thoughts on when ProsperCap is gonna be issuing a dividend? I'll just combine the questions. They're also interested about maybe any target dividend yield and also maybe occupancy levels.
Dividend yield and occupancy levels are two very different things.
Yeah. This is perhaps just focusing on the dividend yields. Yeah.
Okay.
Yeah.
Ching, you want to pick up that one, and then again I'll pick up at the back end on the occupancies and wrap that one up.
I think in our annual report, we state that we do not have any dividend policy. So dividend is only paid out of retained profit. So at the moment, we are making sure that the operation are running and optimized to use the best return. And when there are excess return, we will consider to return some of the return to the shareholders. Yeah.
Thank you, Chiang. And just a last point so that I wrap up your point on occupancy. We look at, I think earlier on, when Chiang was going through the financial section, he shared the operating metrics where we look at occupancy, we look at ADR, the average daily rate. You multiply both of those, you get your RevPAR, which is your revenue per available room. So I always say that revenue management is Harry Potter stuff. It's a black art which none of us fully get. You need a lot of expertise, and Valor has got very good people doing it, where you're balancing your occupancy with your ADR, your average daily rate, to produce the best RevPAR. So that's the first level that we look at. How do we maximize our RevPAR? Because that's what you eat. You don't eat occupancy. You don't eat the highest room rate, because imagine an absurd scenario where in a hotel you have 10 rooms out, but they're all earning £1,000 a room. It may not be so good. It may be better to earn £100 a room and let 200 rooms out. So we got to balance those. The second part that we have to do is, having balanced those, we get reports, and those of you who are familiar with hospitality, we participate in something called the STR reports, which are where you have to submit 5 hotels that are your competitive sets, and everybody else submits. Nobody knows what each person is getting, but you get the average of your comp set, which includes yourself. Are you higher or lower? And we have an index, an RGI. It's a revenue index. And we look to see that we are over 100% in every situation, because the moment you're over 100 means you're the market leader. So that's what we fight for. I don't know if that helps you to understand how we look at it. And, lots of smart people out there, but we try and do the best we can on that basis.
All
But
right.
thank you.
Thank you very much. The time is 1:04. So thank you so much for Mr. Iqbal and Mr. Oi for your time, for the valuable insight into ProsperCap's strategy, operation, and outlook. So before we actually end the session, do you have any closing remark that you would like to make?
The only remark first thing I would say is to thank Phillip Securities and thank everybody for being with us and listening to Chiang and myself today. We really appreciate your insightful questions. Actually, we learn a lot from your questions, because now we know what you care about. And that will help us to do better for you, I hope. The third is that what I would like you to go away with is that, number one, we have a good portfolio, stable earnings, stable assets. Number two, we've built a strong management team that can take us into the future. Number three, we have clear strategies that can take us and build out this company and build out this business. So we look forward to you following us and to your support as we go forward. Thank you all so much.
All right. Thank you very much. Yeah.
Thank you, Serena. We'll leave now.
Thank you, Serena.
Thank you to the audience for joining us today. I hope you find this session insightful. So we look forward to connecting with you again at a future event. So thank you, goodbye, and have a wonderful day.
Thank
Bye.
you.
Bye.